Right. So I want to highlight, especially for the CTA, but I need help from the CTA guys and the MAC 3761. I want to know from your starting information which topics are you going to be starting with in terms of test number one. The information that I'm giving you, I took it from the 2025, 2025 study guides. Sometimes they do change and switch up and start with finance instead of costing. So, but we'll deal with that after the class. I will need you to send me the latest study guide. So I'm using 2025 here. Hopefully, the material is still consistent. Right. So for MAC 4861, if the material is still consistent, we are starting with the costing part as in the previous year. And test number one will be covering learning unit number one up to three. Right, in which case we then have nature and classification of cost. We have variable and absorption costing. We have APC costing in learning unit number one. Learning unit number two will be job costing, process costing, joint and byproduct. And then we end with learning unit three, with the most important thing there being a cost profit volume analysis. So these are the topics that you should be concerned about. Remember, uh, as long as the material is consistent from 2025, still looking at 2025 info here. Right, MAC 3761, you have similar information, though we differ here and there. So, but in common, we have cost classification and estimation. We have CPV, we have budgetary control, we have direct and indirect costing. Right, we have APC here, which is overhead allocation. But you also have standard costing, process costing, as well as relevant costing, which the CTA will not be worried about for now. So we'll concentrate on the topics that are common, and then we'll have separate class for wherever there are differences. Right, MAC 3701, you do everything. So all is good today. Right, so these are the topics relevant to each group in terms of their test number one. So let's start our session. We are going to be looking initially at the classification of course. So that's the starting point. Right, classification of course. Right, so mostly this is the theoretical background to management accounting. Very, very important. It sets the mood for the module for the rest of the academic year. You need to be very clear on the theory behind whatever it is that you'll be calculating as you go along the module. Right, so this is mostly theory, right? You are talking about classification. When we talk about classification, of course, we are saying how do we group and name costs of a similar nature together? How do we group and name cost of a similar nature together? That is what we call classification. Right, in terms of classification, we have the following classes of costs. Right, we have the following classifications of costs. Number one, we have what we call direct, right, and indirect costing, right, or direct and indirect costs. So this is our classification number one. Right, so often in management accounting, you will come across the term direct and indirect costing in many different topics. You need to be very clear which costs fall under direct, which costs fall under indirect, and how you come to that determination. Right, so I'll start here with the direct costs. Right, this should be a revision for everyone. It's covered in your second level in management accounting most of the time. Right, so when we talk about a direct cost, this is a cost that is specific. Right, this is a cost that is specific, right, or directly attributable, right, directly attributable, right, to a particular product. Right, so this means the cost was incurred, that the cost was incurred, right, only for that particular product. Right, the cost was incurred for that particular product. Right, so we normally describe a direct cost as easily identifiable, right, easily identifiable, right, on the final product. Right, so often I describe this as meaning to say we can accurately calculate, right, we can accurately calculate, right, the consumption or cost per unit. Right, let's mute if we are having noise in the background. Then we can always unmute when we want to make a contribution to the class and then mute again. Thank you. Right, let's make sure that we are muted. Uh, where is the noise coming from? Right, you are allowed to unmute, make a contribution, and then mute after so that we have a smooth class. Right, so this means that you can accurately calculate the consumption, right, or cost per unit. So any particular cost that you're dealing with, you can easily calculate the accurate cost per unit. Right, so let's list some examples of direct costs. Right, so we normally have direct material, right? We have direct labor, right? We can also have, right, direct overheads, right? Direct overhead costs, right? With the direct material, right? Most of the time when you buy material, right, you would have identified the product that you want to manufacture, the quantity that you want to manufacture, and then you go and buy material that usually is specific to that particular product. So usually material is a specific cost. It is bought for a particular product so that it is therefore easy to calculate the cost per unit because that particular cost of material, it is not a shared cost with other products. So this is basically a material, right, used in producing the final products. Right, of significant value. Right, so remember we are saying with material that is direct, it is bought specifically for a particular product. So therefore that will make it direct because it is not a shared cost. Right. However, we must be clear that direct material represents significant value on the final product. Because if it's a low value a cost of material or insignificant value, right, then it will be described as an indirect cost. I will explain why when we get there. Right, then the direct labor, this is the labor of employees, right, engaged in production. Right, so remember, production occurs in a factory. Right, in the factory, there are many different employees with many different jobs. Right, you will have those employees that handle the machines and do the actual production. Those are direct labor. right? But you also have other support employees who may not be engaged in manufacturing directly. For example, supervisors, managers, maybe cleaners, and other people, such as maybe maintenance. Those they are in the factory floor, but they provide support to those engaged in direct production. So when we talk about direct labor here, we are specific in saying these are the employees that are on the production line, not any other employee. As long as you are not on the production line, but you are support, you cannot be the direct labor. Right, then direct overheads. Remember, I'm listing example. It can be anything, right, or any costs, right, as long as there is one factory and one product being produced, right? And one product is produced in that factory. Right, so sometimes when you are in production, you can find that you have more than one product being produced, right? But sometimes you may find that you are a company that has got just one product that they're producing. So it simply means that all the costs that you are incurring are specifically attributable to that product because you only have one. But when you have more than one product that is being produced in the factory, there are certain shared costs which cannot be directly attributable to a particular product, but they are shared costs. So if you have more than one product and you've got overheads, most of the time they will be shared cost, which means they will not be direct costs. They will be indirect costs. So this here, in terms of example, can be anything. We can be talking about electricity, right? We can be talking about rent. We can be talking about water, right? We can be talking about any other cost. By the way, when we talk about the term overhead, right? Any cost that is not direct material, any cost that is not direct labor, it is an overhead. So in a factory, when we look at a factory, if we leave out the direct material and the direct labor, what remains is an overhead, regardless of whatever type of cost it is. Then it becomes an overhead. Right, remember, central now to the classification of a direct cost is that we can accurately calculate the cost per unit of that product. Now, this is very easy to do, right? Because, for example, if I buy material at a cost of 10,000 and I use it to produce only one unit, all of it is attributable to one unit. It means that I can easily calculate the cost per unit and it will be accurate at 10 Rand. Now, this is because all the material that I have, which cost me what? 10,000 Rand, was actually used for the production of one product, which I assume is a uniform product of the same size. All the units produced are the same. So therefore, we can easily trace on the final product and say, in terms of the direct material, maybe it's plastic, each unit consumes 10 Rand per unit. If you can do that with a cost, then it's a direct cost. So you simply say total cost divided by a quantity. Then it will give you cost per unit. So therefore, we are saying the cost can easily be traceable right up to the final product, and we can accurately determine how much each product actually consumed. Then it's a direct cost. Right, when we have, say, overhead, let's say we have rent, right? We have a factory that we are renting, and our rental expenditure for the year is 20,000. Right, if we are producing one unit, one product type, and we happen to produce 1,000 of that, then we can also accurately say each unit that was produced consumed 20 Rand per unit. So that makes it a direct cost because we can easily and accurately trace on the final product how much it cost us to produce that unit. But if you have a factory and you're paying rent of 20,000, but you have got product A, product B, and product C, and these products are different and they take up different spaces on the production floor. It means this amount of 20,000 will then have to be split into these products. Maybe this one 10,000, maybe this one 5,000, maybe this one 5,000. But this type of splitting, it is based on estimates. So you need to come up with a system that you can use to estimate how much each product actually consumes in terms of the rental expense. Right, so you come up with an allocating base. For example, you can say this is rent, and our rent we are charged per square meter. Then you estimate and say, right, on the production floor, how many square meters does the production chain for product A occupy? If it occupies 50%, then you can expect that 50% of the rent must go to the product. Then you allocate like that. If you assume that the other two products each they occupy a quarter of the space, then you charge a quarter of the what? Of the space. But we are saying that type of allocation of overhead, it is but just an estimation. It can never be accurate. Right? For example, let's say we have a production flow, one product takes 50% of the space, but you may find that maybe you work only for 1 month, sorry, for 1 week during the month to meet your production targets for that particular product. But there is a product that actually occupies a quarter of the space, but production goes on throughout the month. It can be argued that using square meters to allocate the rental expense is not accurate. So therefore, when you have a production flow with different products, to do this now, you are just going to use estimates. Now, when you use estimate, it is no longer accurate. And when it is not accurate, it is not easily traceable to the final product. So therefore, you are dealing with an indirect costs. Are we clear with the explanations, good people? Are we understanding that? Right? Are we on the same page?
Yes.
Clear, David.
Wonderful, wonderful. Right, let's look at what we call indirect costs. So it's just the opposite now. Right, so if we are looking at the indirect costs, I just want to check. All right, thank you. Right, indirect costs. So we are saying these are not easily traceable. Right, these are not easily traceable on the final products. Right, so in other words, we're saying these are not attributable directly to a particular product. These are not directly attributable to a particular product. Right, but it comes from shared costs. Right, comes from shared costs with other products. Right, another way of describing this, not possible to calculate accurately. Right, the cost per unit. Right, instead, we use estimated cost per unit. Right, let's look at examples that we can give. All right, so we do have what we call indirect material. We do have indirect material. Right. So most of the time, material is a direct cost. So remember, we said you don't just go and buy material and say, I would think about what to produce when I have the material. That's not how things work. Usually, your sales team will tell you what is in demand after market research, and then you sit down and calculate the number of units that you're expecting to sell, and then you calculate and estimate the material that you would need for that production. Then you go and buy the material. So that when you are buying material, it is specific to a particular product, including the indirect material. Right. However, the crux of the matter with the indirect material is that it is of insignificant value. Right, this is direct material. Right, let me not use material, direct material. Let me say this is material. Right, used to produce a product. Right, used to produce a product. Right, but is of insignificant value. Right, insignificant or low value. Right, compared with the overall cost of the product. Right, compared with the overall cost of the product. Let's give some examples here. Right, let's say glue, right, used to bind, right, a high value book. Right, so you have seen these, especially these old books with brown or black covers that are nicely made and look very expensive, like the ones that are used maybe say by the lawyer. Right, kindly mute, thank you. Let's mute. All right, thank you. Right, like those books that are used by lawyers, law books, you will see that those books are quite expensive because of the material that is used to actually manufacture those books. But you may find that to bind the books, maybe we have used normal glue, and the amount of glue that is used there will be very, very small. Right, so that it then becomes maybe insignificant compared with the overall value of the textbook. Right, that's an example. We can also give maybe right pins, right, used on furniture. Right, you have seen that sometimes when you manufacture furniture, and then maybe you're going to put some cover on top of the furniture. It can be made up of maybe resin material or plastic material, and then you fasten it up maybe with some staple pins or something of that nature. Right, so you use a few pins of staples here and there to fasten the furniture together, pins that you obviously don't see because they are normally under the furniture. Right, so the value of those pins may be very, very small compared with the overall price of the furniture. So what happens now is very simple. Right, let's say you are manufacturing those textbooks. Right, maybe the overall value of the textbook is 5,000 Rand. Right, so that's the overall value. But perhaps in manufacturing that you used glue, right, which actually cost maybe 0.0002 per book. So you find that maybe this is the cost of the glue that you use. Remember, you're going to buy your glue in drums, but you only use just a few swabs of glue on the book there. So it won't really cost that much. It will be just a small figure there. So what we are saying, when you are doing your costings now, especially when you employ rounding off, maybe you round off to two decimal places, right? You may find that 0.002 may actually not be captured in your costings because of rounding off. It will be left out. So however, you don't want to do that. When you are doing manufacturing, you want to capture the overall expenses that we incurred in production. So what you may end up doing is just rounding off this thing here, maybe to 1 rand, so that when you cost it in your book there, right, it can actually appear on the costing. Now, because you are rounding off, it is no longer accurate. You are now just putting an estimate reasonable figure there. So once you use estimates in terms of costing, which are no longer accurate, then you are dealing with an indirect cost. So that is the crux of the matter with indirect material. All material by nature is direct. The only time that it becomes indirect is if the value is so small that you have got to estimate a reasonable figure that you add to your cost. Then that particular cost now becomes indirect because it's no longer as accurate as it should be. Right, let's go to indirect labor. Right, indirect labor, usually these are shared costs. Right, so the indirect labor, usually we are talking about the labor of production support. Right, and management. So these are not directly engaged in production. Right, we're talking about supervisors. Right, we're talking about production manager. Right, production cleaners. We're talking about maintenance. When you run machines, you need the maintenance team to be on hand to support production. Right. So most of the time, these people that do support to production, they work along the production flow. So you'll find a production manager who manages the whole production flow, and you may have three products that are being manufactured today. If you have maintenance, you have got boiler makers and other people that do maintenance, engineers, right? They will not be employed usually, unless if it's a very big company, they will not be employed on one product. They maintain the machines for the whole company, so they move across. So what it means, these are shared costs. These are usually shared. But remember, for them to be shared, you must have more than one unit. Right, you must manufacture more than one unit. If you manufacture one unit, then it means it is a direct cost. You must have more than one unit that is being produced. So that then these costs represent what? Shared costs. You have to come up with a way of estimating what you are going to charge to each product that you produce. Because you are using estimation, these costs then become what? Indirect costs. Right. Finally, we have indirect overheads. Right. So this is the same. These are shared costs. Right. It could be rent, it could be water, it could be electricity, it could be anything. Right. As long as it is a shared cost. So remember, let me give examples here. We can have water, we can have electricity, right? We can have telephone, etc. Right? As long as these are shared costs. So in a setup where you have one product being produced in one facility, then all these costs will now be directly attributable to that product. It then becomes direct overhead. For example, you see I have the similar things here. I have electricity, I have rent, I have water, but I'm saying here you are producing only one product. So all of that cost goes to that particular product. But when we are here, uh, right. Please hold on, good people. Please hold on. Right, sorry about that. Let's continue. Right, so that is direct and indirect costing. Very important term. You need to be very clear on that. Along the way, you are going to do a statement of profit and loss, and the question may ask you to use the direct method or to use the indirect method. So you will have to be very clear on direct and indirect costing. Right. Any questions, good people, on what we have so far? Right. Hopefully, we are on the same page. Right. Number two, we go to the second classification. Right. Classification by nature of the cost. Right. Classification by nature of the costs. Right. So when we talk about classification by nature of the costs, right, the question that we'll be asking is where is the cost incurred? So we are saying a costs is classification, right, is determined by location, right, of the costs, right, in the organogram of the entity.
Oh, ita le tse di boiko le ke ya semile class mo. O o bala macaroni. Macaroni macaroni man se di
Right, please mute, good people. Thank you. You unmute to comment and then you mute after. Wonderful. Right, a cost classification is determined, right, by the location of the cost in the organogram of the entity, right, assuming a divisionalized organizational structure. Right, divisionalized organizational structure. Right, so what we are saying, right, the name of the costs, right, derives from the name of the division, right, name of the division, right, where it is incurred. Right, so the name of the cost derives from the name of the division where it is incurred. Right, so normally we have a basic divisionalized organizational structure as follows. So remember, companies can structure their divisions how they want and how it works for them. But here I'm giving you just a basic structure, a default structure for a manufacturing concern. So usually we expect that you will have the manufacturing division of the company. Right, you will have at least the manufacturing division. Right, you will have the administration division. Right, you will have the sales and distribution division. Right, so these divisions of the company will then give the name of the costs. So remember here we're saying how do you name your cost? How do you group them together like for like? So you will have certain costs that are called manufacturing costs. So this here will give you manufacturing costs. So any cost incurred on the manufacturing division or in the manufacturing division will be known as a manufacturing cost. This here will give you admin costs, administration in full. This here will give you sales and distribution costs. Right, so we are saying the classifications of the cost or the grouping of costs is determined by the division where the cost is actually incurred, where it comes from. Now, you also see that we also tend to call this factory cost, right, or production costs. So these costs are these terms are interchangeable. When someone says manufacturing cost, factory cost, or production cost, they are speaking about the same cost. Now, the key thing here is that, right, these are incurred in production. So these are costs incurred in production. Right, these costs incurred in production, right, these are included, right, in valuing inventory. Right, so when you determine the value of your inventory, you take into account the manufacturing cost. In other words, you don't take these into account. Right, whenever you say, what is the value of closing inventory? What is the value of the units that are manufactured? Right, you only take into account the manufacturing costs. You don't take into account administration and the sales and the distribution. Those are non-manufacturing costs. So these are called non-manufacturing costs. Another term that is used to describe non-manufacturing costs, right, we call these periodic costs. So these terms are very important. I have seen exams that says, in a few words, describe the term periodic cost with examples, 4 marks. So you need to be very, very clear on the terms. You can get theory. Remember, when you are at this level, it's not all about calculations, it's application level. You need to show a greater understanding of things. And one way in which they examine that is a lot of theory. So small things can actually be a problem in exam, such as definitions. You need to be very clear. So periodic costs, these are non-manufacturing costs. Right, so going back to the manufacturing cost, remember we're saying when you are valuing inventory, you only include manufacturing costs. Right, at the same time, right, these are included in the calculation. These are included in calculating gross profit. Right, and remember gross profit needs cost of sales. Right, so whenever you calculate gross profit, we are saying these particular costs that we call manufacturing costs will be included in that particular calculation. Right, in other words, you are not going to include any admin, you're not going to include any sales and distribution when you calculate gross profit. So the periodic costs, since they are not being included in gross profit calculation, these particular costs are written off, right, against gross profit. These are written off against gross profit, right, in calculating net profit. Right, so when you calculate net profit, the manufacturing overhead cost, they are going to be included above the gross profit. Then the periodic costs are those costs that you deduct once you have calculated your gross profit. So you need to be very, very clear about all these terms that I am giving you. Right, so remember, when you are in the factory there, right, examples of costs, these are manufacturing costs. The examples of costs that you'll encounter here, if you are manufacturing, you have direct material, you have direct labor, you have variable manufacturing overhead. Right, you have fixed manufacturing overhead. So these are all different classes of costs that you expect to be incurred in the factory. Right. Also, it is important to note that when you add these two, you get the term prime costs. So prime cost basically is the addition of direct material as well as the direct labor. That calculation is called the prime cost. You can get a theoretical question that says differentiate between prime costs, conversion costs, and periodic cost, 10 marks. So you'll have to be able to explain the differences there. Right, then we have the term conversion costs. Right, conversion cost is direct material plus variable manufacturing overhead, plus both variable and fixed. So it's direct labor plus overheads, both variable and fixed. It gives you a conversion cost. So this is the cost to convert. Right, this is the cost to convert. Right, direct material to finished products. So remember, if you bring in direct material to the factory, you will apply the labor, you will apply the overheads in the factory to complete the products to completion. So those are what we call the conversion costs. Right, so what I have described to you, right, is our default, right, structure. Right, is our default structure for financial reporting. Right, so this is our default for financial reporting, which applies to what we call absorption costing. Right, so let's remember that I'm going to be doing the direct and indirect costing. Right, I will have to vary this a little bit when we call to variable costing. So this system, as I've described it, is the default, the most widely used in management accounting, which is the absorption costing, which is used in financial reporting. Right? There may be another way, or there is another way that we can look at this with a little bit of a variation, which is called the direct costing. So I'll come back to that. But in terms of classification of cost by nature, this is what we are talking about. It gives manufacturing costs, administration costs, and sales and distribution costs. So you should be very clear on the different things that affect, especially the manufacturing division, where things are supposed to go. You know, manufacturing costs, they go into the calculation of the material of the inventory cost, the calculation of cost of sales, the calculation of cost profit, right? But the periodic costs are going to be written off after you have calculated cost profit in an effort to determine your net profit. Right. Any questions, good people, on the Right. Let's mute Makoma. Thank you. Please mute. Right. Any question on classification by cost by nature, good people? Right. So hopefully everyone got that one right. Let's go to the last classification. Right, which is the classification by cost behavior. Right, so classification by cost behavior. Right, so when we talk about classification of cost by cost behavior, right, so we are saying, how does a cost respond? Right, how does a cost respond right, two changes in output. Right, by output here, units produced. Right, so there are two classes here. We have what we call a fixed cost, or there are two main. Right, so we have a fixed cost. Right, what do you understand by the term fixed cost? How can you describe it, good people? Someone please describe a fixed cost for me.
A fixed cost is the cost that they don't change. They are standard. They are constant.
100%. So with the fixed cost, we are saying the total of the costs. Right, the total of the costs remains constant. Right, when output varies. Right, it remains constant when output varies. Right, in other words, the total does not respond to changes in output. Right, the total does not respond to changes in output. Right, when output increases or decreases, the value in total remains the same. Right, let's see if there is a contribution. Right, thank you very much. Remains constant irrespective of any changes in output. Thank you. Right, we can also add that the cost per unit. Right, so let's be clear. Right, what does not change and therefore remains constant? Right, what does not change and therefore remains constant is our total. Right, emphasis on the total there. Right, however, the cost per unit now does change. So on the cost per unit, we are saying the cost per unit increases when output decreases. Right, and it increases when output decreases and decrease. Right, when output increases. Right, for example, if you have a fixed rental expenditure, right, let's put an example friend here. Right, so let's say we have a rent expense for the year. Right, 120,000, that's the rental expense for the year. So let's say in terms of output, you produce 1,000 here, you produce 5,000 here, you produce 10,000. Now remember, when it comes to the rental amount, you are being charged by the owner of the space, probably on square meters occupied. It has nothing to do with the number of units that you produce. If you rent my space and unfortunately you don't enterprise, you don't produce anything, I will still expect my rent. If you produce 2 units, I will still expect my rent, which is charged based on what? On square meters. Right, so let's say our total per year, remember, this is a fixed charge of 120,000 that I'm charging. So it doesn't matter how many units you produce, as long as you occupy the same square meters, I am still going to charge the 120,000. It is a fixed cost after all. Right, however, the cost per unit now does change in opposite direction to changes in output. Right? Remember, if I am having 120,000 units, my cost per unit now, I'm saying 120 units spread over 1,000 units. So which will then give me 120 rand per unit. So this will be the rand costs. Right? If I improve my production and I'm able to produce 5,000 units, each unit is going to consume 24. Right? If I improve further and I produce 10,000 units, each unit is going to produce or consume 12 rand per unit. So therefore, we are saying as output increases, the cost per unit in opposite direction will decrease. As output decreases, then the cost per unit will be higher because this is a shared cost. The more the number of units that share into that cost, the lower the cost per unit. That's why it is important that when you have a factory that you are renting, you need to produce to the maximum possible number of units so that you can reduce your production cost with regards to the fixed manufacturing overheads. If you produce less, your cost per unit will be very high because the cost of rent, which is fixed, which does not change, will be spread over a fewer units than when you produce more. Right, so these are the characteristics of a fixed cost. The opposite of that is variable costs. Right, so with the variable costs, right, we are saying the total changes in direct proportion. Right, the total changes in direct proportion to changes in output. Right, to changes in output. Right, the cost per unit remains constant. So the cost per unit does not respond. It remains the same, right? Despite changes in output. Right, let's give an example. Right, I'll use direct material. Let's use direct material. Right, let's say 1 unit of a product requires 10 kgs of material. Right, at say 2 rand per kg. Right, so it simply means that the cost per unit, right, remember each unit requires 10 kgs. Each kg is costing 2 rand. So each unit requires 20 rand of material to produce. Right, what happens if my output varies? Let's say I start with 1,000. Right, I go to 5,000. I go to 10,000 units produced. So we have our cost per unit. Now the cost per unit is established. It will not be changing. It remains consistent at 20 rand per unit, despite the number of units that I produce. This is a variable cost. The cost per unit will not change. Right, however, my total cost now will change in direct proportion to changes in output. Right, so if I produce 1,000 units, my total cost will be 20,000. As I increase output, if I produce 5,000, my total cost will become 100,000 here. If I produce 10,000, my total cost becomes 200,000. So there is a change in direct proportion to changes in output. Right, so you can see that in the first instance, there is a 20% increase in output. This is 20%, right? It's your 1 divided by 5 multiplied by 100. That gives you 20%. And then there is a corresponding increase in cost, which is 20 over 100 again, which gives you 20%. So when we look at the total cost, there is the changes in total are directly proportional to the changes in output. If you look at the next one, from 5 to 10, there is an increase of 5,000 units. So 5 over 10, that gives you 50. Right. Again, here there is an increase of 50%. So this here is a 50% increase in output. Right, we increased by 5,000, and then here it's a 100,000 rand increase in costs. 100 over 200, it will give you 50%. So we still get 50%. So this is what happens with a variable cost. It changes in direct changes to what? Output. So our benefit, therefore, when we increase output, is that the cost per unit reduces because of the fixed cost. When output increases, the cost per unit, as you can see, reduces. So that's for the fixed cost. So when I'm manufacturing some units, it doesn't matter on the variable manufacturing costs, right? In terms of the unit cost, in terms of the unit, it doesn't matter how many units I produce, it will be the same. But overall, when I take my cost into account, including the fixed cost, the cost per unit was bound to what? To reduce, because the fixed cost per unit will be reducing as we are increasing output. Right, so classification by cost behavior, that's what we have. And then we also have what we call a mixed costs. Right, or semi-variable costs. Right, so when you talk about a mixed or semi-variable costs, right, we are saying the total of the costs. Right, the total of the costs, right, contains a variable total portion, right, or a variable total plus a fixed total. So when we get the total cost, it is made up of a variable element and a fixed element in one. So it is a mixed cost or semi-variable cost. Right, you have seen that with your municipal rates. Right, so example, municipal rates. Right, you see on the municipal rates, there is always a small figure that is fixed there. So if you are paying your rates, maybe they are 2,000, you may find an 80 rand that is fixed there. Right, whether you open the taps, right, consume electricity, that particular expenditure will always be there. It is a fixed amount. Then the additional amount now that brings the cost per to 2,000, it is then based on consumption. The more times that you open the tap, the cost increase, that's variable. The more times that you use the stove, the electricity bill increases. But at the end of the day, that variable element will be added to that 80 rand, which is fixed cost, to give you a total. So we call that a mixed costs. Now, mixed costs contain an element of calculation. right? You must know that a mixed costs, right, mixed costs, right, may be separated, right, into the variable element or the variable portion and fixed portion. So this is an important calculation that is usually required in management accounting, where you have to split a mixed cost into its variable component and its fixed component as well. Right, so here we use mostly the Highlow method. Right, there is another method. This is the one that we use at this level most of the time. Right, we have what we call the scatter diagram. Right, we have simple regression analysis. Right, the only time that we may need to use this, right, is in the assignment. Right, for MAC 3701 only. Right, but the CTA, normally you don't touch on simple regression. It's assumed knowledge. When they ask you in the test or in the exam, they want the Highlow method. The simple regression analysis will probably take too much time to do, so they don't normally ask that. It's a question that can ask you a simple question and require 30 minutes, 40 minutes to complete because it's a long calculation, so they don't normally examine on that. Right, so, but the guys that are doing MAC, assignment number 1, there is always a question every semester with the simple regression analysis. So for you, we will need to cover that. But don't worry too much. What we'll do is I do cover that in another module, MAC 2601. When I'm covering simple regression analysis in MAC 2601, I will invite you there so that we can cover it together for the purpose of the assignment. Right, the scatter diagram, I've never seen it being asked in the exam. So these two, the other guys, CTA and third level, right, you can just go and do your own research on that. Just read through, just do one example of that if you can. Right, but for interest sake, because most of the time you will not be examined on that. But it's always good when something is in the syllabus, even if it's not usually examined, just to go through it and just understand how it is done. These are simple stuff, by the way. It's first year MSc. For you, it will be revision. So let's go and research that. But remember, MAC 3701, I'm going to call you very soon for a class with MAC 2601, where we are going to do an example there. Right, so I want to do the one that we normally cover in this module, which is the Highlow method. Everyone covers the Highlow method, very popular. You can't go to the exam without understanding Highlow methods. Right, the good thing about the Highlow method, it's a very, very simple thing. You should be able to get by. Right, so I've got a question here that I want us to do concerning the Highlow method. So this is what the question says. It's our example. The following information was obtained from the books of Siberian Limited for 6 months ended 31 December of the year 20x8. So we have the months, we have the number of units manufactured in the different months, and then we have the total overhead cost. Right, so we can see that the cost does not remain the same, it changes. But it doesn't seem to be changing in direct proportion to changes in output. If you calculate the change here, right, it will give you a different percentage. If you come here, it will give you a different percentage. So this is not a direct, these are not direct costs. This is a mixed cost. Then they're saying, using the Highlow method, calculate the variable cost per unit, right, and the fixed cost in total. Right, the basic principle is to select the highest and the lowest activity together with the appropriate cost and compare the changes in volume or costs. Right, so we have a situation where we have 6 months of operation and we have different number of units being produced in those 6 months, and they give you some cost here, which are mixed costs. Now we need to find out the fixed element in this cost, and therefore we need also to be able to determine the variable cost per unit. Right, so we are going to use the Highlow method. Now, the Highlow method initially gives you the variable cost per unit. Right, what is the formula for the Highlow method, good people? What is our formula? Right, when we apply the Highlow method, good people, right, we take the highest, right, minus the lowest costs. Right, then we divide this by the highest or lowest activity. Right, so we simply go to our table, then we determine the highest cost that we have here. Right, so the highest cost is 423. Then we also determine the lowest cost, which happens to be 183. So therefore we say 423, right, minus 183, right, divided by. Right, then we go to the lowest activity. Right, activity, we are basically talking about perhaps number of units produced. Right, so here the highest, right, here there is a bit of a difference. Right, there is a bit of a difference here. Right, so you can see that when it comes to December, it has got the highest activity, but the cost is lower than the one that we're having here. Right, this one is consistent. It's 183, which is the lowest, and it gives the lowest number of activity. Right, so when we look at this, we are then saying this one here is the odd one out. It's an anomaly. Right, it is an anomaly. So we tend to leave that one out. So if there is an anomaly, you leave it out in your calculation, right? It is not behaving according to how the behavior is expected to behave, right? Remember, when we talk about cost behavior, we talk about the relevant range, right? So when we say relevant range, right, so we are saying that this is the level of operation that management is observed. Right, and hence can estimate behavior. Right, so it means that you normally operate within this range. So perhaps we normally operate within the range of 0 and 35. Right, so within that range, so we can call this the normal range, the relevant range. Within that range, we have observed how costs behave because we have operated in that sphere. So therefore, we are able to estimate our costs. We're able to determine which is variable, which is fixed. Right, but we are saying when we look at 35,000, the costs are not behaving as expected because the number of units are the highest, but the cost is not the highest. That's an anomaly. You always leave that out in your calculation. So therefore, we are going to use that. So the highest cost must give you the highest activity. If that is not the case, whatever is giving you the highest, like what we are having here, must be left out. So therefore, we are going to use 34,000. Are we clear about that, good people? Are we understanding it? Right, hopefully we are there. We are very quiet. Right, then we can get our answer. So if I say 34 minus 14, that gives me 20. Then 423,000 minus 183,000 divided by 20,000, that is going to give me 12 rand per unit. And that 12 rand per unit is our variable cost per unit. Right, so that is our variable cost per unit. So this calculation here will always give you the variable cost per unit. Right, once we have the variable cost per unit, right, once we have the variable cost per unit, right, then we can go and calculate the fixed costs. So what we have is the element of the variable costs. I'm not sure if I'm following, but the Highlow method depends on the cost if we have an anomaly. Right, there has to be consistent within the information that you have. So one of the easiest ways to check is that the highest cost must give you the highest number of units. So you will see here where we are that when you look at the highest cost here, it is this one. But when we look at the highest activity, it is this one. So you can't use that activity because it does not give you the highest cost. So you disregard that. So you go with 34,000 and 423,000 because there has to be consistent. It's a method of estimation, the Highlow method. It can only work if there is consistency in terms of estimation. Right, good people, just 1 minute. I need to answer someone who is trying to join the class here. Just 1 minute, thank you. I'm reporting what? Thank you. Sharp, sharp. Right, so we have what we call the cost function. Right, we have what we call the cost function, right, which is y is equals to bx plus a, where y represents the total cost. Right, b represent always variable cost per unit. Right, x in management account always represents total output. Right, and a in these types of calculation represents the total fixed cost. Right, so what we do, remember we have y is equal to bx plus a. Right, so we take one of the two, right, either the highest or the lowest cost. So if I take my total cost here, which is 423, right, that represents my y, 423,000. That's my total cost, right? But because I've taken the total cost there, I now need to take a output, which is 34,000. That's my x. Right, then B is my variable cost per unit, which I have just calculated, which is the 12 rand. So remember, it's a variable cost per unit multiplied by output. Right, A is the missing item. Then I solve for A. So it's going to be 423,000. This one, it's 34,000 by 12, which gives me 408,000. Right, is equals to A. Remember, it's jumping the equal sign, it becomes a negative. So 423,000 minus 408,000, so 15,000. So our fixed costs is equals to 15,000. Now remember, the fixed cost is consistent. So it simply means that in all these costs that we have, right, our fixed cost will be 15,000 there, which means the remainder therefore represent variable cost. So if you want to know what the variable cost is, right, in the 183, you just have to less the 15,000 because you know the 15,000 does not change. It remains constant through and through. So you are then able to now split the cost into the variable element and also into the fixed element. Right. Are we clear, good people? Are we understanding that? Right. So you must remember the Highlow method is very common. Almost every paper contains something of Highlow method. It may not be asked separately, but it may be mixed with other topics. It's probably going to contribute some 3 marks, 4 marks for you in any given exam. So you need to be very clear with the Highlow method. Any questions, good people? Are we on the same page? Right, no one is clear, no one is on the same page. Kunze.
Yes, we are.
Yes. Right, so we have done the first part of what is required for test number 1 CTA, for test number 1 MAC 3701, and introduction to MAC 3701. Right, so when you start the management accounting, you must start here with the theoretical aspect and just make sure that you are well reminded of this. Remember, this is something that has been done before. So for you, it's just a revision and it's assumed knowledge in this module. Right, so we want to go now to the next topic, which is learning unit number 2 in MAC 4861. Right, and I don't know what learning unit number it is in MAC 3761, but we want to look at direct, right, and indirect costing. Right, so when we look at this now, these are methods. Right, these are methods, right, for creating income statements. Right, so these are methods for creating income statements. Right, so I'll just put them side by side here. Right, so I have the direct and the indirect. Right, very important topic. You should be very clear of this topic. Right, chances are high that you'll get a question specifically wanting an income statement. But even if they don't ask, this is a topic that cuts across the syllabus. Many of the principles that you use here are embedded in other topics in management accounting. So it's a must that you understand everything perfectly well. Right. So when you say indirect materially,
Sorry, David.
Yes.
I just want to ask, so are you saying this specific topic is only for the CTA students or even
This one
37?
is for everyone.
Okay.
Yes, it's for everyone, and very important, one of the anchor topics in the syllabus, because your understanding here informs you in other topics as well. Ne? So you need to be very clear. Everyone does this one. Right, the direct method now is also known as variable costing.
Sorry, David,
Yes, ma'am.
can you please scroll up a bit?
Mhm.
Thank you. No, that's fine. I just wanted to see that part. Thank you.
No stress, sharp. Right, direct costing is also known as variable costing or marginal costing. So these terms mean exactly the same thing. They are interchangeable. Right, this one is also known as absorption costing, right, or full costing, but this term full costing is no longer being used that much. Right, so these are the different names that are used interchangeable. Right, then we want to look at the main difference. Right, we want to look at the main difference between the two statements. Right, so the main difference is the treatment, right, of fixed manufacturing overhead costs. Right, so the main difference is how we treat the fixed manufacturing overhead costs. Right, under the variable costing, these are treated as periodic costs. Right, but under the absorption costing, these are treated as manufacturing costs. Now, what is the difference? What does it mean in an income statement, good people? If we are saying a cost is a manufacturing cost, and then we name another a periodic cost, and we are busy creating an income statement, right? What is the impact of that? We have already explained it. Right, what will be the impact, good people? What do you say there? Right, the impact is this. This here is going to be included in the calculation of cost of sales. This is going to be included in the calculation of gross profit. Right, this is going to be used to determine value of closing inventory. Not just closing inventory, let's just say value of inventory. Right, when you determine the value of inventory, you always use manufacturing costs. This is written off, right, against gross profit in the income statement. So this talks about the placement of the fixed manufacturing overhead cost in our income statement. If we are going to use the variable costing system, right, then up to gross profit, we don't include the fixed manufacturing overhead cost. We now treat it as if it is a periodic cost when it is not by default. Remember, a manufacturing cost is a cost that is incurred in the factory. A periodic cost is a cost that is incurred outside the factory. But for the purpose of the calculation of a direct costing statement or income statement, we are saying we are going to treat the fixed manufacturing overhead as a periodic cost, which means we are going to write it off after gross profit and not include it in the calculation of gross profit. But when we go to the default, this here is the default. Right, we treat the fixed manufacturing overhead cost exactly as what it should be, which is to treat it as a manufacturing cost, which means we include it right in the calculation of gross profit. Now, this here is done for financial accounting. This is the correct way for financial accounting. This here, this is done for management reports. So if it's done for financial accounting, it means we apply international financial reporting standards and international accounting standards. Here, no standards are required. Management tells us what they need. Right, so whenever you see a question that says you have created an income statement based on the principles of financial accounting, right, or you have calculated the value of inventory based on the principles of financial accounting, you are applying absorption costing. these management reports don't need standards. So as long as you are doing financial reporting, you apply the standards. Therefore, you are using what? Absorption costing. Now, this here is done to give management certain information that they may need that financial reporting does not give them. Right, you will see that when you talk about contribution, which we calculate in variable costing, it is a variable figure or variable calculation. But when you say gross profit, it's not variable in full because it contains both variable and fixed element, in that you include the fixed manufacturing overhead cost. So when you need information that isolates the variable portion of profit, then you have got to use variable costing. For short-term decision making, variable costing is important. That's why we do calculate in this way. Right, and then one more difference that is there, here we calculate contribution. There is no gross profit here. Right, I made a mistake. I said written off against gross profit. No, written off against contribution. Right, so therefore here we calculate contribution. Right, contribution is also known as marginal income. Right, as we already know, here we calculate gross profit. Right, let's give examples of this. Let's give examples. So I'll just extend my table so that I can just demonstrate the differences in the statements here. Right, so let's have an example. Right, of an income statement. Right, so of course you always start with sales. You have your value. Then you say, of course, less cost of sales. This is financial accounting after all. Then you say opening inventory. Right, then you say add direct material. You may have more than one direct material, you add all of them. Direct labor, variable manufacturing costs. So you just add everything together there. Right, so you will see that we also add the fixed manufacturing overhead cost here. Right, this is absorption costing, fixed manufacturing overhead cost. We also add that. Right, so that at the end of the day, we can then get our total available for sale. Right, then from there we say less our closing inventory. So all our manufacturing costs, variable or fixed, they are included in the calculation of cost of sales. Right, so when we get our cost of sales here, it contains variable costs and a fixed cost. So our cost of sales is made up of variable and fixed costs. So which means also our inventory will take into account variable and fixed costs. Sales minus cost of sales, then it gives us gross profit here. Right, from the gross profit, we then say less, we can say periodic costs. or we can say non-manufacturing cost, because all the manufacturing cost we have already what accounted for. But we have non-manufacturing cost. It could be admin, it could be sales and distribution, both variable and fixed. Then we subtract this, the answer that we are going to get, that's our net profit there. So this here is our default in financial accounting. It only looks different because this is a manufacturing concern. So therefore, we don't have purchases. When you have purchases, it's opening inventory plus purchases less closing inventory. But when you don't purchase but manufacture the units that you sell, you need to replace the purchases with the manufacturing costs, which is your direct material, direct labor, variable manufacturing, and fixed manufacturing overhead costs. Right, we also have the direct method here. So I'll give the example there. Sales will always be calculated the same way. It will give you the same amount. Right, then you say less. This time we say variable, right, cost of sales. So we already have a difference in the structure, in the description of the cost of sales. Right here we said cost of sales, but here we are specific variable cost of sales. This is because up to the calculation of contribution, you are not going to include any fixed costs. So therefore, you will say opening inventory. Right, you will say opening inventory. Right, you add that. But now, there is a difference in this opening inventory from that opening inventory. What is the difference for people there? Right, what will be the difference there, good people?
Is it the variable and fixed costs?
Yes, but you see now, opening inventory here, it includes both variable and the fixed costs. That is on the opening inventory there. But here now, right up to the calculation of contribution, we don't include any fixed costs. So the figure here will be smaller because it will only be made up of the what? Variable manufacturing cost per unit multiplied by the number of units that we have in opening inventory. Now this one is going to be made up of variable manufacturing cost plus the fixed manufacturing cost per unit multiplied by the number of units produced. So the variable contribution figure will always be smaller. Right, once we have that, then we add our direct material, our direct labor, our variable manufacturing costs. So, but here we end with the variable manufacturing costs before we calculate our closing inventory. So we don't include the fixed manufacturing cost up to this point. Right, so we just add all these things together. Right, then we get a figure here. Right, we don't name that figure. Then we say less closing inventory. So the closing inventory that we are going to calculate again, it is not going to contain any element of a fixed cost. Right, then we calculate going down. Then we say add, right, other variable costs. So these are non-manufacturing variable costs. Any variable cost that you then incur elsewhere in the factory, you add to the figure that you have there. Then we get our variable cost of sales. So this is going to give us contribution here. Then you say less periodic costs. If you want, you can say less fixed cost here. right? Because you have only taken into account the variable cost thus far. So you can say less fixed costs. Then the first one that you have is your fixed manufacturing overhead or costs, which you bring here. Then you can have your admin, you can have your sales and distribution. Right. Once you deduct this, you are going to get your net profit. Right. This should be the easiest topic to do. Right. Because the detail is simple in where you place the fixed manufacturing overhead cost in your income statement. When we use this method, it only comes in as part of the periodic costing. Right. But when we use the other method there, right, it is included before the calculation of gross profit, which means it is included in the calculation of cost of sales there. Right. So when you say periodic cost, it is no longer going to be included there because it has been accounted for. So that's the main difference between the two calculations that you must be aware of. Once you understand that, the calculations are never difficult. It is just the layout and where you place the fixed manufacturing overhead costs. That should really be what taken into account when you're doing the statements there. Any questions, good people, on what we have on the board?
Hi, David. So are you saying the fixed costs that we removed from the opening and closing inventory are then going to our periodic costs? Is that the gist of it?
Yes, but yeah, something like that. Remember, the fixed manufacturing overhead cost here, when I'm looking at it,
Yes.
they are included here, they are included here, they are included
Yes.
there. Can you see that?
Yes.
Right, so I've already taken into account the fixed manufacturing overhead cost. When I got periodic, I don't worry about the fixed manufacturing cost. They are taken care of. Right.
Okay, I'm asking on the direct costing method, because you did say that the difference now when you're doing the opening inventory.
Yes, so when we are here now, we are saying the fixed manufacturing overhead cost is going to be taken care of there, right? Because it is not
Okay.
included here, it is not included under here, it is not included there. So the total figure of fixed manufacturing overhead cost, it will be dealt with there.
Okay, so anything that's not variable then goes under periodic costs.
Yes, so here we can
Okay.
also just call it fixed cost. It's actually just as good. So all the fixed costs are dealt with here.
Okay, thank you. That's much better. Thank you.
Wonderful. So that's the detail that is there. Anything else is academic. This thing of maybe contribution of which one is default, which one is not. The most important thing, how do you treat the fixed manufacturing overhead? Now, remember, this level, we are not only concentrating on calculations. The examiner wants to know if you've got in-depth understanding of whatever it is that you are dealing with. So it is equally important that you can actually describe the differences. So if you can't do the notes from the head, you can have trouble in the exam because they can ask you, in a few words, describe the differences in the treatment of the fixed manufacturing overhead cost between the variable costing and the fixed cost. It is easy to memorize the calculations, but it is not easy, to understand what it is that you are actually calculating. So at this level, you must go deeper. You must have that theory on hand because the question can be theoretical in 10 marks. Let's make sure we're clear on the theory as well. Right, so that's our theory on the direct and the indirect costing. I want us to do a question next. We take a small break, 5 minutes. When we come back, we are going to attempt a question. So 5 minutes, and when we come back at 10:50, and then we attempt a question. Thank you.
I do things according to my own time.